So where should we put our emergency fund? Is it the bank or the credit union or under your pillows? Well, it is quite natural for us to think that, yeah, the money in the bank is very safe, right? And also it's liquid. When you need the money, you can just go to the drive-through and take a few $100 cash or whatever. Do you know that when things go south, the banks legally have up to 6 months stalling you from drawing money from your own bank account? There's a fun fact that is not really that fun. So in 2008, there were over 400 banks went under and 900 more on the watch list, basically on the brink of going under. Imagine, in that kind of scenario, we have to wait for up to 6 months to access the money in the bank. So is it really that liquid? So the federal government asked the 5 major banks to disclose where they put their tier 1 assets. So tier 1 assets are the assets that they must have on hand, liquid and safe, and access readily in the event of a major run on their bank. So guess what? 30 to 40% of the tier 1 assets in the 5 major banks are in the insurance companies. It's called the bank-owned life insurance. Because for a life insurance policy, you have to have an actual person to be the insured. So in those cases, usually it's somebody on the board of directors or their stakeholders. But then the bank itself is the owner of the life insurance. And similarly, some major corporations keep their assets in the insurance policies in cash value and have a person as the insured, while the corporate is the owner of the insurance, which is called the corporate-owned life insurance, COLI. So many banks are rated a BBB by S&P, while the many insurance companies are rated AA or AAA by S&P. So what are the differences between BBB and a AAA? It's actually 6 tiers different in terms of the safety scores. So here is a true fun fact. Insurance industry is a multi-trillion-dollar industry. So relatively speaking, it is above and beyond safety and secure than banks. Because during the Great Depression and 2008, 40% of the banks closed their door and never opened again. But not a single legal reserve insurance company went under. So whether it is bank, credit union, or insurance company, when you put money in, they're in a lended position. What that means is you lend them the money and they credit you with interest. So why not cut the middleman to get your 5% plus interest rate from the insurance policy directly instead of a less than 1% from the bank? That's not a 4% difference. That's 5 times different in terms of return on your investment. So how easy it is to access your cash in your life insurance policy? Actually, it's only take 1 call away and 2 to 3 business days. Boom, it's deposited in your bank account. So here's a question for you, or some food for thoughts. So which one is safer and more liquid? The traditional bank account or the hidden bank account you set it up with your life insurance company?